Hi, I'm Elizabeth Naumovski, host of Finance is Personal. What is a reverse mortgage and what are the pros and cons of a reverse mortgage? Now, we've seen the star of Magnum PI, Tom Selleck, on commercials in the United States promoting reverse mortgages. And here in Canada, we have world champion figure skater Kurt Browning. They talk about reverse mortgages, but a lot of people don't understand the product. I'm actually excited to do the show because I want to learn more. And I've had a few friends say that they'd like to know more. Today, I'm joined by Yvonne Ziomecki, Executive Vice President, Marketing and Sales at Home Equity Bank and co-author of Home Run, The Reverse Mortgage Advantage. And I'm really excited to do this show today, Yvonne. I actually had somebody reach out on YouTube and say, could you do a show on CHIP? And so let's begin. Our industry is full of jargon. So what is CHIP?
CHIP stands for what actually our product used to be called before, Canadian Home Income Plan. And it's basically a reverse mortgage. So it's a loan drawn against the value of your home. And the word reverse makes people nervous and scares people. But we use the word reverse in the mortgage context to basically signal to people that there are no monthly mortgage payments that are required. Because with the conventional mortgage, you make regular mortgage payments every month, your balance goes down. With a reverse mortgage, there are no payments, but the interest accumulates on the side and you pay it back when you move or sell your home.
Okay, so where and how do you sign up for a reverse mortgage and who should use it?
So there are a couple of ways you can sign up for a reverse mortgage. So you can come to us directly. We have a great website, chip.ca. It has a lot of resources. It has case studies. It has calculators. Our customers are very interested in figuring out things for their own, so they can use calculators, all the information about the product you may want. But we also offer the product through our referral network. So you can go to the bank. We have partnership agreements with all the banks. You can go to mortgage brokers. Most of mortgage brokers across the country know our product really, really well and can help customers. So that's where you can get it. Who should get it? I think everybody who's kind of 55 and older should look at it as an option to supplement their income in retirement or do things that they may want to do. It's for people, when you get into retirement, a lot of people have conventional mortgages where they have to keep making a monthly mortgage payment. Sometimes that's a difficult thing for them to do. Sometimes people are house rich, cash poor. So they're trapped in these homes, Toronto, Vancouver, everywhere that are worth a fortune, but they don't have money to do things that they want to do. And I always say, money is only good for two things. One is to enhance relationships, and the other is to enhance lifestyle. So a lot of people use our product to do one of those two things, or sometimes both.
So, you said, age 55, which is a very young age. And, we always have to worry about having enough savings to get us to, the average woman lives to be 84 and the average man to 80. So if you start at 55, will you run out of money?
So great question. Our average customer is actually 72 years old. So we do offer a product at 55, but I would say that's probably a smaller portion of our portfolio. But you think about people who may get divorced kind of middle age or who had businesses and they may need some bridging. So that would be our typical customer, kind of 55 to 70. Life doesn't always work out as planned. So our average customer is 72. And at that age, they know kind of how life is playing out. They figure out, are there any health issues? Do they want to age in place? What other things they may want to do? And that's how they end up coming to us and looking at the product. Your second question.
Mm-hmm.
Your second question about running out of money.
Yes.
The way that we lend money is that at 55, you'll get less than if you're 79 years old. So we have very conservative lending practices, and it's a bit of a tiered scale. So that's where the calculators can come in handy, because you can figure out at 55, you'll probably get about 20% of the value of your home. And when you get to age 70, north of 75, that's where you start getting up to 55% of the value of your home.
So before I go to my next question, you mentioned the word bridging. Can you explain what bridging is for those individuals out there that don't know the term?
Of course. So the context that I meant it in is, let's say you are 56, 57 years old and you were displaced. And in the pandemic, we're seeing that a lot. And you no longer have your job and your pension income is not kicking in. So sometimes people need money for the next 3, 5, 7 years before they get pensions, before they start drawing from their investments. Or same thing we're seeing right now in the pandemic, business owners who were in their late 50s, early 60s, they were planning on selling their business and that was going to be their retirement money. Well, now is not a great time to sell many businesses because of what's been happening for the last year and a bit. So while they're waiting for things to get back to normal, they still have expenses. They need to pay the bills. So they use the product for, a shorter period of time.
This question just popped into my head as I was listening to you speak and saying that the average homeowner, your average client is 72 years of age. Well, when an RRSP turns to a RIF, and then you have to start, withdrawing money from your RIF, that's 71. So I would assume that this is to supplement your RIF payments to help you with your lifestyle.
For some people, yes, but what we find is at 72 years old, you've kind of gotten into retirement a little bit. Like you're in the groove. You know what your lifestyle looks like. Sometimes health problems start appearing in early 70s, and what you thought your retirement would be is not always what you've planned for. And I think at that age, people think, I do need personal support worker to come in to help out, or my husband has dementia and he needs to go into a home and I can only afford a home that's $5,000 a month, but he really needs $8,000 of care. So I'm going to take CHIP and get that $3,000 a month for it. So I feel like it's a little bit driven by real circumstances. And once you enter retirement, you're excited at 65, you think, what's going to happen. And then, things change.
Life happens.
Change a little bit. Life happens always, right?
Right.
Yes.
So I'm very strategic in things that I do. Like I like to do pros and I like to do cons. So let's just go through the pros of, taking a reverse mortgage.
Of course. So number one, we always talk about it. It's aging in place. It's staying in the home that you love. And we do research over and over again. Over 90% of people tell us that they want to age in place in the home. Now, during the pandemic, that number would probably be higher because that's where people feel safe and secure. So number one, you get to stay where you love to live and your home and where you have a lot of memories. But to me, the biggest pro, the second but the biggest pro is you stay in the house, you get a reverse mortgage. And, I have a scenario of $1 million home, which I know it's hard to find $1 million home right now. But let's say today you have $1 million home and you take a CHIP reverse mortgage with us and you take it for $170,000, which is on average what people take. So your net equity left is $830,000, right? Because you took out the money, you're going to be spending money on other things. So fast forward 20 years, your house, and I run this scenario at a very conservative 3% appreciation rate because things happen, markets go up, markets go down. So in 20 years, that house is worth $2.6 million at 3%. It's probably worth more because average 15 years in Canada is 5%, but let's say it's 3. So that house is worth 2.6. Yes, there is interest on the mortgage, and that interest is about $270,000. So it's a lot of money, right? You only borrowed 170, there's another 270. But if you work the numbers, you have $2.2 million of equity in 20 years. So the biggest advantage is when you take CHIP, you stay in your house. Interest is only on the amount that you advanced, and the entire value of the house continues to appreciate over time. What does it mean to a homeowner in those 20 years? they have options. They can downsize, they can rent, they can go into a retirement home, they have more money for inheritance. I think people often don't think about the upside of a CHIP reverse mortgage. They just think, oh, there's going to be interest, I'm going to have to pay. But you get to stay in the house, you get your cake and you get to eat it too.
So, okay, so what are the cons of using the reverse mortgage?
So if let's say you have a lot of income coming in, it could be pension income, it could be investment income, and you don't, you have other lending options available to you. For example, you can qualify for a low interest mortgage, or you can qualify for a line of credit. I would say, if you can get a mortgage at 1.5% and you can afford to make payments, you should go with a conventional mortgage, because why would you pay 4 or 5% for CHIP if you can get something at 2%, right? The other thing to think about is if you are not planning to stay in your home for quite a few years, and you're just thinking, maybe I'll move next year, probably doesn't make sense to get into CHIP, because it's more structured for people to stay in the home, to age in place. And last answer, it's not exactly the con, but who it's not for people who have a lot of debt. And I'm sure you see it, we see it all the time. There are a lot of older Canadians who have a lot of debt, and they come to us and we can't help them because it just doesn't make sense for them. And so if you have a lot of debt, if you own very little of your house in retirement, it's not the right product for you either.
So is it, we talked about people with a lot of debt, so which means a lot of people that are in dire circumstances are really not the proper client for a reverse mortgage.
No, they're not, because you think about it, if they owe a lot of money on their existing mortgage, and then we give them another mortgage, and that mortgage then starts accumulating interest, there will be absolutely no equity left for them at the end of their days, or when they're ready to move out. And that's not really a good outcome for them. We pride ourselves in providing a product that lets people age in place, helps them stay in a home they love. And we also guarantee that at the end of the term, they'll never owe more than the fair market value of the house. There are products that there's news sometimes south of the border, where reverse mortgage holders are in circumstances where they actually, owe bank money, or their heirs own the bank money. That's not how the product works in Canada.
So if you owe money, how do you repay it? Like, how does that whole scenario work out?
So it's actually simpler than people think. So we actually have clients from 1992 still on the books. So let's say it's April 1992, and you take out $100,000 from your house through CHIP reverse mortgage. You get to stay in the house as long as you want, and maybe you're going to live to 100, who knows. When you decide to either move out of the house or sell the house, or you pass away, that's when the loan has to be repaid. So you let us know that you're selling the house, or your family lets us know that you passed away. And then we say, okay, so you owe the $100,000 you borrowed, and over all these years, this is how much interest has to be paid. And it's like any other mortgage. If you were selling the house, you have to pay back the lender, and then you get to keep the rest.
So how do you get your money back from a reverse mortgage? And what about the fees? What kind of fees do you have to deal with other than a higher interest rate?
So how do you get the money? So if you get a reverse mortgage with us, we will deposit money into your bank account. If you have existing mortgage on the house, what we will do with CHIP, we will first pay off that existing mortgage. That's how and why a lot of people come to us, because they have mortgages or lines of credits, and it's hard to make regular payments when you're in your 70s or even your 80s. So the receipt of money is really straightforward. The fee is $1,795, so $1,795, and it covers all of the legal fees. It covers us checking the title, making sure there's title insurance. Again, it's stuff that is included with conventional mortgages. That's every bank has to do it. We're a federally regulated bank, so we we do those things. There is an extra fee that you have to pay, and it has to do with our process. We ask every customer to go and get independent legal advice because we think it's really important. Maybe not at 55, but at 10 years down the road, 15 years down the road, your health things may not be the same, and we don't want any surprises for us and for customers' family. So in a lot of cases, our customers go to their family lawyer, somebody they know, and it's one last step. Somebody walks them through the process. So that's additional cost that they have to pay out of pocket.
So somebody's gone through this whole process. What could cause them to default on the loan?
So there are 3 obligations that people have to keep. One is having insurance on the house. Again, it's no different than a conventional mortgage. So having insurance, paying property taxes, and keeping house in good condition. And good condition is very arbitrary, but doors, windows, those types of things. Yes, the usual. Nothing out of ordinary.
What about penalties? Does anyone have to pay a penalty, say, if they sell their house before whatever the deadline is or the due date?
Yes, that's a very good question. So the way that our interest rates work, you can pick a term. And yes, there are penalties. So, when we talk about the product's really designed for people to age in place and stay in the home. So if you pay back within the first year, there's a 5% penalty. Second year is 4%, and third year is 3% penalty. And after that, it's just 3 months interest. And again, it's the same as any of the conventional banks. So when I was telling you before, when people think about it, if you're thinking you're moving out in a year, that's probably not the right product. Now, we did create a product just during the pandemic called Chip Open. It has no prepayment penalties because we know that plans change and pandemic has been so unpredictable. People really don't know what they're going to do next. So we have a product that doesn't have penalties as well for people available. It's the newest product that we added to our suite.
It's interesting because, as I said at the beginning of the show, I had somebody on YouTube comment and say, can you do a show on this? And then I was talking to a friend, and they don't have a pension, and basically they said, well, this is our retirement, and this is what we're thinking of doing. And that's why I wanted to look deeper and more into reverse mortgages, because it's something that I personally don't really know much about other than speaking to you today. Yeah. And that's why I've got all these questions, because, once these questions get answered, it's so much easier for people to understand the product and then, see whether it's right for them or whether it's wrong for them.
I absolutely agree. And so I love what we do. I love our product. I love my job. And the best part of my job is talking about the product and explaining it to people, because I find people are nervous, or people think they know, or they just don't want to, ask a silly question. And the only way you're going to be able to figure out what is right for you or make the right decision is if you ask a lot of questions. So we have all the patience in the world. And I've been actually calling our customers with Kurt Browning, who is our ambassador. And we've been calling customers who are in the process of getting a reverse mortgage, or those who have funded either recently or a couple of years ago. And one thing that's very common, it's a bit of a theme from all of them, is how they took a while to get comfortable because, they heard different things and they just wanted to learn for themselves. And they asked a lot of questions. They tell us we were very patient in answering, provided a lot of resources. At the end of the day, it's a very personal financial decision. But I think, it's worthwhile looking at the product. It's not as scary as people think. And it honestly, it's a life changer for a lot of people. So that's why I'm so passionate about it.
And that's why I like doing this show, because a lot of times people don't know what the proper questions are to ask. And I figure, if I can just go out there and just ask as many questions as possible, it just allows people to be able to educate themselves a little bit more, do their, go further with their own research, learn a little bit more about the product. Now, we talked about an estate earlier. How much time, say you pass away, your client passes away, how much time does the estate have to pay off the loan's balance if the individual passes away?
So up to 12 months. we find, it's difficult time when somebody passes away, and it's really difficult to get through all the paperwork and probate. And again, I keep bringing up pandemic, but things are slowed down, courts have slowed down, etc. So we give family up to 12 months. Now, if you need a little bit longer, we're very flexible. We'll work with you. In some cases, adult children want to, buy back the house, or in some cases, we actually have adult children moving into the house and taking on a reverse mortgage of their own. So we're able to arrange for that as well. We offer 6 months for people to pay us back when they move into a nursing home or retirement home. We find this gives them a really good peace of mind as well. Although you usually move into a home, very rarely do you ever come back home. But we find people want to feel like if they improve, or if they want to, they can come back. So we give them a 6-month window to come back. But after that, the house has to be sold or the loan has to be repaid.
Now, what happens if the amount of the loan ends up being higher than the price of the property?
So we guarantee that you never owe more than the fair market value of the house. So let's say it's really unfortunate circumstances. You have a house that's worth $500,000. You borrowed $300,000, and then there's a nuclear plant and the waste disposal and train track and all the things that don't make it for a very attractive piece of real estate can happen. And over time, the interest and the principal exceed fair market value of the house. Our company, Home Equity Bank, will take a loss, and you get to walk away. The downside is you walking away not really having equity, but you also do not owe any incremental money. So that's the guarantee that we provide.
I just want to go one step back again, because we talked about the interest rate. So how much does a reverse mortgage cost? Because the interest rates are higher than regular mortgage.
Yep.
And I know we touched upon that earlier.
Okay, so I'll give you an example, like a real life example, maybe not because there are no $600,000 houses, but it's one that I like to use. And it's actually one that I used in the book to illustrate a point. Mm-hmm. So let's say you have a $600,000 house and you take out $100,000 reverse mortgage on day one. So in a year's time, let's say the real estate market goes up by 5%. So your house is worth $630,000. So that's great. It could be more, but let's just assume that it's 630. Interest rate right now for a 5-year term is 4.89%. So at the end of the first year, on that $100,000 that you borrowed, you owe, let's say $5,000, just rounding it up. Mm-hmm. So the point that I tried to make in the book is you make $30,000 on the value of a house, and the interest cost is $5,000. So net 30 minus 5, you're ahead, let's say $25,000. You do have an option at the end of the first year to pay $5,000, and some of our customers actually do that. They're good at saving. They no longer have to make payments on other debts and so on. So they've been able to put money aside. So you can pay the interest. You also can prepay some of the principal. So maybe you get inheritance, or I don't know, won a lottery, small lottery. You can also pay down some of the principal. So we do offer it. Not a lot of people take us up on it over time. They like the not having to make payments, not having to worry about it, and just kind of accumulating on the side. But that's it's 4.89, so it's a lot higher than a conventional mortgage, but you don't have to make any payments. We guarantee you'll never owe more than fair market of the value of the house, and you get to stay in the house as long as you want.
So talking about your book, you talk about new retirees. Do you want to explain to everyone what new retirees are?
Well, so it's funny because I use this term, a new retiree, and then I go on to talk about the fact that there isn't one new retiree because everybody's just different, right? And as we get older, I turned 50 last year, and I plan on working for a long time or being active, and I work in this industry, so I talk about retirement or read about retirement or see retirement every day. But I find there's so many different paths. There are people who want to retire and not work and not do anything kind of extravagant and just relax. And I find there are people who want to move on to their second careers. and they're building businesses. There are people who want to travel. There are people who are going back to school. And they're just people who kind of, want to keep living their regular life. I really like that because I don't like putting, I don't like the word seniors. I don't like putting people in these big cohorts. I think it's actually incredible. And I don't like labels. I don't like anyone telling me who I am and what I should do. And that's the new retiree. Every new retiree is different and kind of making their own future.
So, there's a lot has changed in the past 10 years with reverse mortgages. And I know that this was something that you wanted to touch upon.
Yes, absolutely. So, I've been working for Home Equity Bank for almost 8 years. And even during that time, sometimes people used to refer to it as a loan of last resort, or people thought it was just for people who were in debt and didn't have any other options. And what has really changed, it really is not a loan of last resort. It is for a wide range of people. People are buying second properties with proceeds of a reverse mortgage. People are giving money to family to get into the real estate market while they still can. And we've expanded our product suite as well. It used to be just kind of one size fits all lump sum product. If you had a lot of debt, you took it. But we have products I talked about. We have Chip Open, where there's no prepayment penalties. It's super flexible. We have a product called Income Advantage, where you can take small amounts of money on regular basis. So it's really great for home care, health care, or just supplementing income. We have a product called Chip Max, where you in certain geographies, you can qualify for even extra money to help people who may need a second mortgage, for example, on top of Chip. And it just gets really complicated. So we've become a lot more flexible, I think. We appeal to a broader range of customers. And then we've been growing phenomenally. There's a lot of interest and a lot of need for a product like that for people heading into retirement.
So what did you learn the most about yourself when you wrote the book?
That's a really good question. I learned that I'm a hard worker and that I'm very determined and I don't give up no matter what. Writing a book is a lot of work, and I have a day job. So it took a lot of work, a lot of research, but I really wanted to get it done. I enjoyed writing it because I wanted a book that wasn't too technical, because just technical books can be really, really boring, and they can also be overwhelming. So it was actually a great way for me to share my story. I came to Canada when I was 18 from Poland. My family still lives in Poland. And I talk about my girls, I talk about my parents in the book, my home ownership journeys. So it was a nice trip down memory lane, I think, because we often don't do that. And I still think I'm pretty young, but it was just nice to kind of put it down on paper and think, wow, there were so many great moments in my life. But yeah, I think the grit and not giving up, because there were so many times where I thought, I just can't do this. This is just too hard. So it was very satisfying to finish it.
Thank you so much for your time, Yvonne.
Thank you.
Different things happen in our lives as we get older. Our health might deteriorate and our family circumstances might change. There are always specific products for specific solutions. So just as every product, make sure that you ask questions and feel comfortable with the outcome. And whenever signing any documents, make sure that you read the fine print. If you like this video, click like. Please read the disclaimer in my YouTube description because it is really important. And please look out for my next episode, and remember to subscribe to my YouTube channel. You'll automatically get new video alerts. And follow me on Twitter at Naumovski. Thank you so much for watching. Bye for now.